What's up everyone, it's Leo. Welcome to the channel with another real estate video, and today we're going to talk about appreciation. A lot of people have been talking about a lot of assets going up, real estate's going up, stocks are going up, playing cards, cars, exotics, everything's been going up, right? So there's different levels of appreciation and different categories of appreciation and how something appreciates. So I'm going to hit all of them. There's 4 of them. So let's go over the first one. What is really appreciation? Well, it's used to refer to an increase in any type of asset, such as a stock, bond, currency, or real estate. So let's talk about the first type of appreciation. What affects it? It's inflation, right? So if we print more money, something is worth more money, right? So that's because as the dollar, more dollars are printed, that item is increasing. So that's the first thing. The second type of appreciation is increased demand for an asset. So let's say we have the same amount of money flowing around and more people want, let's say, a red Ferrari convertible, and there's only 10 of them, then the price is gonna go up because the demand of an asset has increased. Same thing with real estate, right? If you see more people bid on a house for real estate, that means that the price is gonna go up. So let's go to number 3. Number 3 is reduced supply of an asset. So let's hypothetically say that the asset has less of it on the market, like the real estate industry right now. Right now we have few houses on the market. And because we have few houses on the market, it's called a supply shortage. So you have a supply shortage, there's few houses on the market, there's more people bidding on them. This is what creates an inflated appreciation and increase in prices. That's why we saw houses going for $100,000 over asking, and that is another reason of appreciation. And the fourth and final type of appreciation is changes in interest rates. Now, as interest rates go up, the appreciation goes down. And why this happens is because the actual cost of money to buy that asset, it costs more money to utilize that debt to buy that asset, which in turn creates the deflation of that asset. So because the increase in interest rates, it makes the asset go down in price. Let's say we take a single family home, and that's worth about, that's $350,000. If it goes up 1 point, I would say that it drops the housing prices down about half a point. So that's what happens with real estate. Every point that the interest rate goes up, we usually lose about $50,000. So if on a $400,000 house, interest rate went up 1 point, it would be $350. If it went up another point, it would be $300, and vice versa. So that's why you see a lot of times when the interest rate kept on dropping, the real estate prices went through the roof, because people generally do not care about how much the house costs. They care about the monthly payment. And it's correlated between interest rates and how much debt you could borrow. So the cheaper it is to borrow debt, the more money an asset costs. So I hope this clarified what assets are and how they appreciate. So it's just like, even with Michael Jordan baseball cards. I don't know if you're familiar with Michael Jordan or Wayne Gretzky baseball cards, but the more Michael Jordan cards that were on the market, that actually, that was a supply of an asset. I think there was only like 10 of them that were like PSA 10s, and they were worth a lot of money. Same thing with the Wayne Gretzky card. I think there's only 2 in the world that are PSA 10, and they were worth like $1 million each. So that's basically the supply, the reduced supply of an asset that created this inflation. So I hope that clarified a lot of things for you about asset appreciation, and I'll see you in the next video.